All right, perfect. So let's start. First of all, thank you very much for joining another Into the Block webinar. Today, we're going to be talking, this should be a very exciting topic. So we're going to be talking about a lot of practical lessons about algorithmic trading in DeFi. We're going to sort of disclose and cover some practical sort of best practices that we have discovered in implementing algorithmic DeFi strategies at a very sizable scale. The agenda is very, very simple. So, but we have a lot of ground, a lot of content to cover. So we want to start by sort of demystifying some of the key questions about DeFi, like, all these yields, where do they come from, and things like that. Then we want to talk about the components of a DeFi strategy. If you're thinking about building algorithmic DeFi strategies, what are the key components that should be part of it? Then I want to spend a couple of minutes on discussing the nature of alpha in DeFi, because it's very different from anything that you will see in traditional capital markets. And then finally, we have like 10 lessons that we sort of pay attention to when working on DeFi quantitative strategies, and probably something that will be practical and insightful for you guys. At any given point, feel free to use the Q&A panel, and I will stop several times during the presentation to cover this. Before we start, as usual, we want to give you a quick update about Into the Block, about some of the new things that we have done. First of all, I think in our previous webinar about NFT analytics, we talked about the fact that we were doing a release in that area. Well, it's live. So if you go to intotheblock.com today, you're gonna see our NFT analytics release, one of the first in the market, and you can see a lot of different cool indicators about this that track activity at different collections, trends, and things like that. And we have this is the first of 3 releases that we're doing on the NFT analytics side. We have a new release coming up very, very soon. And also we have done quite a few customer launches, including different websites, exchanges, wallets. So Into the Block analytics continues the distribution. We typically don't talk a lot about what we're doing on the DeFi quantitative side, just for just the nature of that operation is requires a lot of discretion. But we've recently crossed over 60 DeFi strategies in production, working with a very, very large scale. And hopefully a lot of the lessons that you're gonna see here today, and also a lot of the more philosophical theses that we're gonna discuss, are based on what we have learned in this first iteration of the ITV DeFi quant platform. As I mentioned before, here we have a new release of NFT analytics coming soon, and also a couple of new blockchain runtimes that we're going to add. So that's as much as we want to cover for the Into the Block update. So let's dive into the topic for today. So before we start going deeper into the archetype of DeFi strategies, there's some sort of almost philosophical questions, or more like existential questions about DeFi that we should try to answer. So obviously everything in DeFi today is about chasing yields, at least from the algorithmic trading standpoint. So a normal question is, where do those yields come from? Like, people that don't follow this space, they tend to associate these yields with Ponzi schemes. I was even listening to a podcast from a very prominent CEO in the crypto space that gave an explanation to this, and it's probably one of the most ignorant things that I have heard in a long time. So even though the interview was very good, but that segment was almost laughable in terms of showing like a lack of understanding of how DeFi looks like, because obviously you see these yields, particularly in the current markets in which there are no yields anywhere. Like the U.S. Treasury are yielding about 2% for 10-year notes. There is a lot of systemic risk in the market. There is a lot of geopolitical uncertainty, inflation, and all sorts of other things, and you're still getting these high yields in DeFi. So how is that even possible? Is it just a matter of supply, demand, and matching one with the other? Not quite. I mean, we can have an entire session just debating this, but there are three factors that fundamentally uh, are the source of yields in DeFi. One that is often overlooked, and it's probably the biggest one, is a leverage for stablecoins. So there is a massive demand for stablecoins in the market, and the supply is not anywhere close to that. So that amount of leverage is the cause of a lot of yields in the space. Obviously, another, and again, we can go into the mechanics of how that actually works. Another source of yields is obviously the new tokens that are launching that incentivize you to be part of the network. So just with that level of participation, you're being rewarded, and there's some yields that could be captured that way. And obviously, the one that most people are familiar with is all these incentive programs that are being created by the host of these protocols that are incentivizing based on supplying liquidity, based on participating on the protocol and other things. And that's also a cause of yield. There are other causes of yields, but these three are the main fundamental sources. And when you combine those three, there are a lot of things that that could be done. Another existential question in DeFi is this, you know, a temporary thing, or is this sustainable? Can you really keep up those yields for a long time? And a while ago, I published a paper about this, about the fact that DeFi, given the key architecture principles of the space, might not, it's not trivial whether it will become an efficient market. So obviously, most capital markets are they're somewhat, I like to say that they're efficiently inefficient, right? Obviously, most of you are familiar with the efficient market hypothesis created by Eugene Fama and sort of perfected by Kenneth French in the 70s. And a lot of asset classes in capital markets behave based on that any inefficiencies in the market is being captured very quickly and the markets return to efficient behavior. In DeFi is not so trivial. So there are several factors that conspire against any level of efficiency in DeFi. So for instance, the asymmetry of information is massive, right? If you're in a protocol talking to the developers and all that, you have access to information that nobody else has. There is a huge mismatch between the activity in centralized exchanges and DeFi. The diversity of protocols, so this space is just starting. You're seeing new protocols are so different from anything else that it's just thinking that everything is just going to become efficient at some point. It's a little far-fetched. Then the space is very fragmented in terms of blockchains. Bridges are just starting. There is a lot of inefficiencies there. Governance is a royal mess. Last week I published an article in CoinDesk about this. Governance has to improve because right now governance is a source of inefficiency in DeFi. And obviously you have this thing, you know, that you need to deal with hacks. So every time there is a hack, it completely alters the dynamic of the market for a very, very long time. So there is a lot of inefficiencies that could be captured there. So this is likely to last for quite some time. Now, how big can it get? Right now, if you look at DeFi, it's really a crypto to crypto thing. I like to call it like a pillow fight, right? Like we're just moving crypto from one place to the other. That's going to change, right? So we're going to have DeFi, CeFi bridges, DeFi traditional finance bridges. And then where this is going to become very big is when you start creating rails of DeFi for other asset classes. Think about DeFi for equities or commodities or real estate or all sorts of other things. And then when you start incorporating DeFi, another area of growth, when you start incorporating DeFi as part of first-class financial services, we're seeing a couple of attempts in the market to use DeFi to pay real estate mortgages and things like that. I think that has an incredible potential in terms of growth. So those are existential questions about DeFi. When you try to formulate this in the context of algorithmic strategies, right now the market is so asymmetrical that almost anything works. But if you try to boil down this to first principles, any systematic, meaning algorithmic strategy in DeFi has to have two fundamental components. One is the financial logic of it, and two is the risk management logic. For the most, there are all sorts of other things, but those two are paramount to any strategy. But financial logic, we mean things like, supplying liquidity to a protocol, borrow lending, hedging, anything that has to do with the financial mechanics, the financial workflow of a strategy. Now, when you think about risk management, so risk management in DeFi today is really, really, really tough. And you're gonna see some examples of that. So DeFi is at a state today that the financial logic is simple, but the risk management logic is very complex. And that's likely to, I have this theory of how this is gonna change in the near future. So by risk management logic, I've referred to things like managing impermanent loss or liquidations in lending protocols or slippage in liquidity pools or dealing with governance proposals and things like that that could alter the financial behavior of a protocol. Now, if you want to map this down to a technical view, everything that you want to do in systematic strategies in DeFi obviously requires a data infrastructure. From that data infrastructure, you need to extrapolate signals, whether it is there is an alpha decay, there is impermanent loss, things like that. Automation is key. So, and you're going to see a lot of examples of monitoring everything, being able to exit in positions, integrated with protocols, monitoring mempools. This is key. And then on top of that, you're going to have your financial logic and your risk management logic. So it's the same thing that I told you, two components, financial logic, risk management, but what is the technical underpinnings of a lot of that? Now, obviously, we build strategies to capture alpha in DeFi, but alpha in DeFi is very different than what we consider alpha in traditional capital markets. This is another paper that I published a few weeks ago. So in traditional, when we think about alpha in DeFi, it's not even trivial to even how to define it, right? In traditional markets, alpha is essentially the portion of a return that's outperforms a market index. And because market indices are a very good representation of markets, they're accepted as a standard. And obviously, since the 1960s, there was an entire movement with passive investing and smart beta in the 90s and things like that, that created an entire theory around indexing in capital markets. Now, the thing about indices in capital markets is they're based on price, because the thing that you trade is a price. So if you have an index that has the fan stocks, well, I mean, it's based on a representation of price and market capitalization. Relatively easy to do. Now, when you look at DeFi, if you create the indices that exist today are based on prices of tokens, but that's not a representation of alpha, because where the alpha is in DeFi is the yields. So you can have holding uni or holding comp or CRB is not a one-to-one representation of the yields that you can obtain in those protocols. So the concept of index is completely messed up in DeFi, and by proxy, the concept of alpha is really undefined. So the notion of alpha is really beating the yields that you can get by just putting capital in a specific protocol. So even mathematically, it's way more complex than a formula that you would use for a traditional market index. I hope that makes sense. Happy to debate more. Now, where this gets really, really, really interesting, and this is a theory that I've been developing recently. I'm working on a paper about this, is that I believe there is a friction between alpha and risk in DeFi today. So very, very simple way to explain it. Today in DeFi, the market is so asymmetrical that anything works. So you can get nice returns by doing three stupid things. But the risk management of those strategies is very complex. So today, managing liquidations, slippage, and all that is extremely complex. How this should play out is that tomorrow, the protocols start becoming more risk conscious, and a lot of that, and they do a lot to mitigate the risk. They absorb the risk. So you can think of protocols that already mitigate impermanent loss, that they don't have crazy liquidations. We're seeing iterations of this with Bancor B3, with Aave B3, and things like that. So the easy alpha is going to go away. So you need more sophisticated strategies, like in a traditional capital market, but the risk management is going to get simpler. So I believe that's how it's going to play out. That's how it should play out. But today it's very easy to be seduced by high yields in DeFi, but you can get killed on the risk management front. So this is another way to explain it. So alpha in DeFi could be captured today very simple with very dumb strategies, but you can also go to zero very quickly if you don't have proper risk management. As more capital and more quants and more strategies flow into DeFi, there's going to be different levels of efficiency, even if the market remains inefficient. But it's going to require more sophisticated strategies that involve multiple protocols and things like that. But on the flip side, the risk management should be simple. So the talent today, the magic of trading in DeFi at a scale is on the risk management. In the future, it's going to be on the strategy side, and the risk management is gonna become simpler. Happy to debate this because I'm sure that a lot of people could disagree with that. Now, in doing these things at a scale, we have identified a lot of tips and lessons learned and made a ton of mistakes that are not enough to capture in a single presentation. So I took 10, right, that I think are sort of simple to explain, and to show you guys some practical examples of some best practices that at least you should be aware of if you're serious about trading algorithmically in DeFi. So let's start with some general tips and then go into more technical side. So this is something I repeat a lot, and it seems dumb, but it really is not. That in DeFi today, infrastructure beats strategies. So it's very easy to be attracted to the returns produced by a strategy. But in DeFi today, it's really, strategies have a massive alpha between. So you can have a strategy that is returning 20%, and there's a governance proposal that changes that. And somebody was telling me there are audio issues. Is that okay? Uh-oh. Is it better now? Is it better? Hello? Okay. No. Still bad? Okay, hold on 1 second. Okay, guys, is it better now? Tell me. Okay, awesome. Great. Thank you for all the comments about the robotic voice. It's awesome. So in DeFi today, there is a lot of alpha decay. You can have a strategy that does 20%, and there is a governance proposal that kills it, and it goes on to zero in a day. So discovering new strategies is key, and for that you need an infrastructure that allows you to discover new strategies, that allows you to switch from one strategy to the other. At the same time, there is a lot of risk conditions. So you need an infrastructure that allows you to monitor and detect risk conditions and move very quickly. Speaking of that, another tip is monitor everything. So this is a practice that we follow into the blog. We just monitor things that we don't even know what to do with. But there is alpha decay in DeFi is caused by many reasons that are not tied to the underpinnings of a specific strategy, that just have invisibility across all the yields, governance proposals, changes on different protocols, news, and things like that is super important. So, for instance, this is an example of a strategy that we do in ETH STETH pools, in which we are monitoring the composition of the pools. That is really tied to the slippage of the strategy. So we're literally monitoring how much ETH versus STETH is on the pool and whether that's acceptable given the statistical behavior that we want in the strategy. And you can see places here in which quickly that goes out of whack. By the way, this was a trade done by Justin Sun that removed 70,000 ETH from this pool in one transaction. So those type of things, having that type of visibility is super important. Now, also another general point, risk management in DeFi is very different from anything. Again, this is another paper that I published a while ago. DeFi in traditional risk management in traditional markets is tied to volatility. That's fundamentally it. Risk management in DeFi has nothing to do with volatility, but it has to do with things like a smart contract risk, which is the one that most people are familiar with. But the biggest one is economic risk, right? There is a lot of factors. I'm going to show you some that cause economic losses in DeFi protocols. There is governance risk. There's risks associated with the blockchain or L2 that you're using underpinning. So these are factors that we monitor for risk in our DeFi strategies, from everything from addresses that are associated with arbitrage to the concentration of whales, to addresses that are active on MEV, to inflows and outflows of liquidity, like all sorts of things that are not related to volatility, but that can kill a position at any given time. So let's look at some other tips more from the technical side of things. So one thing that we follow religiously, and I couldn't tell you how important this is to automate the exit logic. I will say the entry logic on a position too, but assume that you can assemble a position manually. The thing is that in DeFi, things change so fast, and exiting a position often requires coordinating activities between different protocols. You need to go to an AMM and liquidate a position, or you need to do a recursive borrow and lending that is not trivial to do manually. And because risk conditions are 24/7, having logic that allows you to get out automatically is super important, because sometimes exiting manually is not an option. Now, there are many risk conditions in DeFi. One that I found to be one of the most difficult ones to deal with, and one of the can kill positions. We have had a lot of issues dealing with this, is the whale exposure. So if let's say that you're in a liquidity pool and you're monitoring all sorts of things, right? You're subject to certain slippage criteria, but then there's certain large token holders in that pool, and one of them decides to move all their funds out in one transaction, in one block. If you're not seeing that ahead of time, it's really impossible to recover from that. And we have had like really scary. I show you the Justin Sun 70,000. We have had very scary scenarios with this. So this is really hard to deal with. The way that we do it is we analyze all the pools and quantify the whale exposure. So you can see this is an example of all the addresses in a pool that are above certain amount, and we run simulations real time that tell us what happened if this whale exit. By real time, I mean block by block, and that allows to stay ahead of potential risk conditions. And this is an example of why even in DOM strategies, risk management is very complex. You can have a strategy that is just supplying liquidity to curve, like a very dumb thing to do, but then a whale exit and you have a massive slippage and you're stuck in that pool forever. So in that case, having this level of whale simulations, right, a lot of Monte Carlo simulations for this is important. So impermanent loss or divergent hedging, that is one of the areas that the industry talks a lot. This is far from trivial. I cannot tell you how many hours we try, how many things that we have tried here. So at this point, I'm convinced that there is no universal solution to hedge impermanent loss other than a token solution, somebody that launches a token that moves in the inverse to the impermanent loss, or some insurance products or things like that. But an automate, like a universal hedging model, doesn't work, because one is the contracts for derivatives for different tokens look very different, and they're really nothing to do with the impermanent loss. So until somebody launches comprehensive impermanent loss derivatives, there is no universal hedging. There's some hedging. You can do it for Bitcoin and Ethereum. It's expensive as hell, but it can be done. Now, one area that we have had a lot of success with is finding pools with assets that are largely correlated. So they move in tandem up and down. So there is no divergence between the two, which is what causes impermanent loss, and monitor that, right, block by block. This is an example of a position with dozens of millions in AVAX and ETH. And you can see this is a chart that shows impermanent loss. You can see that it's positive, meaning in the trader's favor, right? And it drops a little bit, but it's remarkably positive. So this position has no risk, even if it's in a liquidity, even if it's in a liquidity pool. So this type of trades we think are way easier to do than to try to hedge with options and all sorts of things. Then monitoring governance proposals is key. We have seen some examples lately. Governance is a source of alpha, it's also a source of risk in DeFi because governance is so simple today. It's one token, one vote type of thing. Is subject to all sorts of market manipulation. And a bad proposal can alter the behavior. I guess a good proposal can also alter the behavior of a protocol. So actively monitoring these things and simulating, having simulations that give you the output of a governance proposals is key. And most of these governance proposals are based on economics, right? Altering weights and all that. So they're very easy to simulate. You're gonna do it automatically because somebody has to interpret the text, right? But once you know what the proposal is, simulating the impact ahead of time is very easy. And most of these things are not real time, although the ones that are real time, crap like this happened, right? So you saw that Beanstalk a few weeks ago got exploited for 182 million. This was a governance attack in which somebody had the idea that a governance proposal under certain conditions could be implemented automatically. So this attacker did a flash loan to borrow the tokens, pass a governance proposal in their favor, and was able to exploit the protocol. It happens. But again, this is an example of how governance could play both ways. Then another tip another thing that we have recently played with. So the concept of MEV, of minor extractable value, is typically seen as a source of alpha, right? As a way to hide, to hide the visibility of a specific trade, but also as a risk management asset is also very, very, very efficient. So in typically we think about MEV on the flash bot scenario of sending a trade that the front runners are not seeing and getting an edge that way, and that's valuable. But then there are many scenarios in which doing those trades to protect yourself from a risk condition is equally important. For instance, think about this scenario that we just mentioned. You're in a liquidity pool and you look at a mempool and you see a transaction from a whale that is going to exit right there, with a massive amount of token, and it's going to cause a slippage. So you can evaluate that risk and say, well, if this guy's exit, we're gonna be subject to excess slippage, and you can then try to front run that transaction, exiting your position, pay more, and place that transaction ahead of the whale on the block, so you're not subject to that that level of a slippage. So that's an approach that is very efficient, in which MEV could be used as a defensive rather than offensive mechanism. Then another tip is related to bridges. So this is a year of DeFi bridges, and we use bridges all the time. Bridges are complicated, right? Depending of their trust model, they're trustless and trusted. Bridges, ones are fast, but vulnerable to hacks. One are very slow, but more secure. So the point here is that in strategies that are multi-chain, you should plan for bridges to be very unstable. So you should plan for all things of congestions, like very high fees, like all sorts of things, the risk associated on different times of day. So it's a very, very vulnerable, very, very fragile aspect of DeFi strategies, particularly if you're doing systematically. Because if you're moving funds algorithmically as part of a strategy, then you need to rely on real-time bridges. And the real-time bridges are the ones that are subject to all sorts of vulnerabilities, right? Because they don't have off-chain components. They have it's all there, and they're subject to all sorts of exploits. And then the last tip, at least in detail, is if you think about DeFi derivatives, that obviously any financial market in history has a derivative component to it. DeFi is not going to be the exception, but today most DeFi derivatives really, really suck. So most of the contracts are really basic. They're somewhat poorly formulated. In some case, the TVL is really, really low. So if you're going to use derivative for things like hedging and stuff like that, your best bet today is centralized exchanges. Hopefully that would change. We have been researching this space for a while. If you go to the into the blog Medium post, you can find some blog posts from our research team that go very deep into the DeFi derivative space. Unfortunately, we haven't found anything that is a very practical use just yet. This is still at a scale, like with hundreds of millions, right? With a smaller scale is practical. So some other tips that you should be aware of. So information remains incredibly asymmetric. Again, so you can have, this strategy being vulnerable to tweets with bad information, to like all sorts of things, right? There are people that know stuff about DeFi protocols that you don't, and you should assume that's a way. Today, because liquidity is constantly moving from one protocol to another, we see this all the time. There is a lot of TVL in one protocol, another thing launches with better incentive, and liquidity flows from one to the other. So you should try to play that game or be prepared to live in that type of world. So any DeFi strategy that you have has dependencies on L1 or L2s, and this could be from Solana going offline for 7 hours, right, to Polygon issuing killing an incentive liquidity incentive program that affects some protocols. So all sorts of things that could happen, from technical to more governance, that could affect your strategies. A lot of the higher alpha today is in multi-strategy protocols, so multi-protocol strategies, sorry. So things that combine many protocols, they're typically yielding higher. There is arbitrage opportunities. We're looking at a bunch of them, but the thing is, arbitrage is the opportunities are juicy but very small, like hard to do with large amounts of capital, and somewhat competitive. There's some new protocols that came to the market that are probably opening the door a little bit more in terms of arbitrage strategies. And then something that we play with a lot with not great results is active liquidity mining. So ideas like Uniswap, B3, Trident, and things like that, they're exciting. They're also super risky, right? Like it's just hard to manage the risk. For those things, we try a lot of different models with volatility predictive models and things like that. It's still unclear whether you can do that and still be safe. And we're seeing it in the market. Like these protocols have gotten traction, but they haven't been like a massive success or anything like that. So quick summary of what we discussed. Every DeFi strategy is a combination of financial and risk management logic. DeFi alpha, when you think about what alpha means in the context of your strategy, is very different than beating an index, or at least the indices that we have. Today, everything you saw in today's presentations from running this stuff in real world scenarios is not theoretical exercises. So hopefully you found some value in that. The next webinar, we're gonna be talking about the Ethereum Merge. Our head of research, Lucas Otomura, is gonna give you a deep dive about the potential impact and ramifications of the upcoming, postpone again, Ethereum bridge. So with that, I would like to open for Q&A. And I think that our team just posted the link of the presentation. So if you have any questions, feel free to use the chat or the Q&A panel. So there is a question, Thomas. No, but I did. So Thomas asked about cross-chain arbitrage. There is a lot. Now, there is when you look at the opportunities to cross-chain arbitrage, they're there. But the problem is bridging becomes really difficult. So you have to do things and move the capital on both sides up front and being able to reconcile. Now there's some protocols like what Layer 0 is doing, what Hashflow is doing, that are quite of how they're abstracting the multi-chain aspect. So this is likely to get more and more viable in the next few months. Any other questions? Cool. Well, questions going once, questions going twice. Well, thank you very much for joining this webinar. I hope you enjoy the content, you found it valuable, and we'll see you in 3 weeks in a new edition of the ITV webinars. Oh, another question. Johan is asking about well access simulations. How often do you take into consideration? We do it block by block, but it's discretionary, right? Like you can do it based on whatever criteria makes sense for your strategy. In our case, we do it block by block. Like we don't want to take any chances. All right, well, that was the last one. So thank you very much, and I hope to see you in the next one.